Welcome to the Deep Dive, where we take your source material and really unpack the most important insights.
That's right.
Today, we're diving into a really key economic report for Ireland. It's the ESRI's Spring 2025 Quarterly Economic Commentary.
Yeah, and this one's crucial. It gives us that sort of official expert take on where things stand now, early 2025, and importantly, it maps out the potential road ahead for the next couple of years.
Exactly. So our mission today is, to cut through the jargon, cut through all the raw numbers, and figure out what are the absolute core takeaways from this ESRI report for 2025 and looking into 2026 as well.
What's driving things? What are the biggest potential risks?
Yeah, and what does it actually mean for, jobs, prices we pay, and let's face it, the housing situation, that's always key.
Absolutely. Think of this as your shortcut, really, to getting a clear picture of the economic landscape ahead straight from this expert analysis.
Okay, let's get into it. The report kicks off by painting a pretty positive picture, actually, of the economy coming into 2025. It calls it a strong position. What are the sort of headline numbers backing that up?
Well, the key things the ESRI points to are definitely looking solid. Unemployment, for instance, hit 3.9% back in February 2025,
Wow.
which they note is the lowest it's been since, April 2001? So
Right.
a long time.
That's really low.
Yeah. And real income growth, that's your wages after inflation, which is really matters for spending power, that's set to be pretty strong, too. Over 3.5% expected in 2025.
Okay. And are we seeing that strength kind of reflected in government finances and just, people and jobs?
We are. Exchequer returns, the tax take basically, continuing to rise significantly early in the year, and total employment hit a record high, around 2.8 million people working at the end of 2024. So yeah, the baseline does look strong.
Now, something the report uses a lot, and it's really important for Ireland, is this term modified domestic demand, or MDD. Can you just quickly remind us why that measure is so vital here, maybe compared to standard GDP?
It's absolutely critical because, Ireland's standard GDP figures can get massively skewed by the big multinational companies. Right.
Things like aircraft leasing or big transfers of intellectual property, patents, and things for R&D. These can make the headline GDP number jump around wildly.
Yeah, without really reflecting what's happening, on the ground in local businesses.
Exactly. So MDD adjusts for those huge, volatile, often foreign-influenced items. It gives you a much clearer view of actual domestic activity spending, investment happening within Ireland.
Got it. So it kind of cuts through that multinational noise. So based on both MDD and GDP, what are the ESRI's baseline forecasts for growth? Assuming, and this is a big assumption, no major new US-EU trade war kicks off.
Right. The baseline forecast without that big disruption is for MDD growth of 3.0% in 2025.
Okay.
And then slowing just a touch to 2.8% in 2026. GDP growth is forecast stronger, 4.1% this year, 3.9% next. But this follows a really interesting kind of weird period recently. GDP actually contracted sharply in 2023, down 5.6%.
Which sounds terrible. It does. But it was almost entirely driven by those foreign sectors, the multinational stuff. Then it bounced back about 1.2% in 2024.
And the report really highlights that split, doesn't it, in terms of gross value. Added the foreign side, causing all the swings, while the domestic side is more steady.
Precisely. Yeah, figure 2 in the commentary shows it perfectly. That big drop in 23 and the rebound late last year. Almost all down to the foreign-dominated sectors. The domestic sectors, which tell you more about the underlying health, have shown pretty consistent, slower but steady growth.
Right. So that underlying domestic bit is the strong position they're talking about.
That's the core of it, yeah.
Okay, so that's the sort of solid domestic baseline. But almost immediately, the report pivots, doesn't it? It flags a major international risk right at the start, U.S. trade policy uncertainty.
Yeah, they don't pull any punches there. They describe the international climate as particularly fraught. And they specifically mention the new U.S. administration talking about potential tariffs. The big worry, obviously, is that any serious trade war, any real deterioration in global trade, well, that's bad news for a small, very open economy like Ireland.
Yeah, we're very exposed.
Hugely. Plus, just the general uncertainty itself tends to make businesses nervous, hold back investment, consumers maybe spend a bit less globally.
And this uncertainty isn't just like a vague worry. It's already baked into their main forecast to some degree. They've already trimmed things back a bit.
That's right. They mentioned they've adjusted their external assumptions downwards compared to their previous commentary, precisely because of this heightened uncertainty. So the baseline already reflects some caution.
Okay, but here's where it gets really specific and, frankly, a bit concerning for Ireland. The report details our specific export exposure to the U.S. Just how vulnerable are we if tariffs did come in?
Yeah, the numbers here are quite stark. The report focuses on goods trade, which is where tariffs usually hit first. And Ireland has incredibly concentrated exposure to the U.S. in a few absolutely key sectors.
Like what?
Okay, pharmaceuticals, massive industry for us. 44.4%, nearly half of our pharma exports go directly to the U.S.
Wow.
And pharma itself makes up almost 45% of all our goods exports.
So a huge chunk of a huge sector relies on the U.S. market.
Precisely.
Yeah.
Then you've got organic chemicals, another big one. Over 36% goes to the U.S., and that's nearly 12% of our total goods exports. Professional and scientific kit, medical devices, that kind of thing. Over 40% goes to the U.S.
It's not just a theoretical risk then, is it? It's core parts of our export engine that are really, really reliant on that one market.
Absolutely. And Table 2 in the report shows even some smaller sectors overall have very high reliance. Like beverages, think whiskey, Guinness, maybe nearly 40% of those exports go stateside too.
So if tariffs did happen, how does the report say that would actually ripple through the Irish economy? What are the impacts?
They outline a few channels. First, the direct hit. Our exports become more expensive in the U.S., so we sell less. We might also pay more for U.S. goods coming here. Then you get the sort of second round effects. Global demand might fall generally because of the trade friction. And crucially, investment here could drop because businesses just get nervous about the future, about the uncertainty.
And the ESRI even tried to model this, right? They looked at a hypothetical 25% U.S.-EU tariff on goods. What did that simulation show for our growth?
Yeah, they ran that scenario under that specific model, and they stress its simplified MDD growth, that domestic measure, slows quite a bit, down to 2.8% in 2025, and then further to 2.1% in 2026.
Heck, a noticeable drag.
Definitely. And GDP growth also takes a hit, slowing to 3.7% in 2025 and 2.8% in 2026 in that scenario.
It's a clear negative impact. But the report is careful to add some warnings about this model, isn't it? It's not necessarily a precise forecast of what would happen.
Absolutely. They're very clear on the caveats. The model assumes things like a uniform tariff hits everything equally and that it all happens smoothly, which, let's be honest, is unlikely in a real trade spat. And crucially, it can't really capture individual company decisions or, disproportionate impacts on specific sectors like pharma, especially if U.S. policy is actively trying to encourage companies to move production back to the U.S., the whole shoring idea.
So the real-world impact could actually be worse than the model suggests. These numbers might be a sort of best-case bad scenario.
That's the implication, yeah. The estimates could be seen as a kind of lower bound on the potential negative effects.
Okay, let's maybe shift gears now from those global risks to a major domestic challenge, one the report spends a lot of time on: housing supply. The numbers here seem pretty starkly disappointing.
They really are. Completions, the number of new homes actually finished, came in at 30,330 units in 2024.
Which sounds like a lot, but
it was actually down from the 32,500 finished in 2023, so we went backwards last year.
And that 30,000 figure, it's nowhere near what's actually needed, is it?
Not even close. The report references estimates of structural demand just keeping up with new households forming, population growth that's at least 46,000 units a year, minimum.
Minimum.
Yeah, and if you factor in the backlog, the pent-up demand from years of undersupply, some estimates push that need up to 50,000, maybe even 60,000 units a year.
So we're potentially short by 20,000, maybe 30,000 homes every single year just to stand still or catch up.
That's the scale of the gap, yeah. We need a huge increase just to stop it getting wider.
And how's the investment picture looking? Are we seeing money flow into building more homes?
Not really encouragingly. Overall, building and construction investment actually fell by just under 3% in 2024.
Ouch.
And residential investment, specifically home building, end of the year, Q4 2024, saw a 17% drop in residential investment compared to the year before.
17% drop, that's significant.
It is. It suggests things were slowing down quite sharply towards the end of last year.
The report's breakdown of completions by type in Figure 8 is also quite revealing about what isn't getting built. What changed in 2024?
Yeah, that figure shows that scheme housing, estates of houses drove increases after 2016, but that seems to have plateaued now. It's static. Single one-off houses, also pretty static.
So where did the drop come from?
The big decline in 2024 was specifically in apartments. They fell quite sharply, from about 11,500 units in 2023 down to 8,700 in 2024.
Right, and that drop in apartments leads us nicely into the report's deep dives on specific constraints, things like rent controls and funding, which probably hit apartment building harder.
Exactly. The report flags these, among other things, as likely factors making it harder to deliver enough supply, especially those more complex, higher-cost apartment projects.
Okay, let's dig into rent controls first. Rent pressure zones, RPZs. Box A in the report looks at this. What's the ESRI's take on how effective they've been?
Well, Box A explains the basics, the RPZ rules aiming to limit rent increases, which are up for review soon as they expire end of 2025, and how the cap changed from 4% initially down to the lower 2% or HICP inflation more recently. And it applies both when a tenant stays on and between tenancies for the same property.
And the evidence they cite from the Residential Tenancies Board data, it seems to show they have actually slowed rent increases for people living in those RPZ areas.
Yes, the study they mention, by Slaymaker and others, is pretty clear on that. It concludes RPZs have been broadly effective at limiting rent hikes within the designated zones. For ongoing tenants in RPZs, rents went up much less, maybe 1.3 to 1.7% a year on average.
Compared to outside RPZs.
Compared to 3.5 to 4% increases for ongoing tenants outside RPZs. And even when a property was relet to a new tenant, the increase was lower inside an RPZ, maybe 3 to 6%, compared to huge jumps of 14 to 16% outside RPZs.
So for the people actually renting in those zones, it has provided some level of stability, some protection against massive hikes. The report sees that as a real benefit for affordability.
Definitely. That's the positive side highlighted. But then the report pivots, looking at the wider economic evidence, the international literature.
The potential downsides.
Exactly. A review they cite notes that rent controls, especially stricter ones, aren't costless. They can have unintended consequences, like reducing tenant mobility, discouraging new construction, maybe reducing overall supply, and sometimes leading to less investment in maintaining properties.
And are these kinds of effects showing up here in Ireland?
The report suggests, yeah, these effects do seem to potentially be present here. They talk about the two-tier market. It creates new renters paying way more than sitting tenants for similar places.
Yeah.
And maybe less turnover, less fluidity in the market. They highlight another study by Gillespie and others that found RPZs actually led to more homes being listed for sale, but fewer rental listings, especially after the rules tightened in 2021. And that seemed driven by individual landlords exiting the market.
So the specific design of the rent control, how tight the cap is, really matters for these side effects.
That seems to be the key message. Calibration is critical.
What specific problems does the report identify with the current RPZ system as it stands?
Two main things stand out. First, linking the cap to monthly HICP inflation, but capping it at 2% means that over time, rents can't even keep pace with the general inflation. This effectively becomes a very strict control, preventing any real rent increase.
Right.
And international evidence suggests these stricter controls tend to have more significant negative side effects on supply and maintenance. Second, the way areas are designated as RPZs means some places with very high rent inflation don't actually qualify.
Okay. Box A also floats 3 potential options for reforming rent controls going forward. What are the basic choices and the trade-offs involved?
Yeah, they sketch out 3 paths, none of them easy. Option 1, revise the caps, maybe link them to something more stable like average inflation plus a bit CPI plus X, and maybe apply it nationally. Simpler, but the risk is rents could still fall way below market or maintenance costs over the long term if there's no way to reset them.
Okay, what's option 2?
Option 2, keep a cap on increases while a tenant is in place, but allow the rent to be reset to market levels when the property turns over to a new tenant.
So, stability for the tenant, but flexibility for the landlord eventually.
Kind of. But the big concern flagged here is that this could create a really strong incentive for landlords to end tenancies just to get the higher rent.
Right, potentially leading to more evictions.
Exactly. So that would need incredibly strong security of tenure laws alongside it to work fairly.
And the third option?
Option 3 is a more fundamental change, introducing reference rents, pegging allowable rents or increases to what similar properties are renting for locally.
Sounds complicated.
Very. The report notes significant practical challenges for Ireland. How do you calculate a fair reference rent in a market that's already been distorted by controls for years? How do you deal with really small local markets where there aren't many comparable properties? What about differences in quality, BER ratings, age, size? And it's unclear how this system would handle the economics of brand new high-cost apartments.
So the takeaway from Box A seems to be, RPZs have helped sitting tenants manage increases, but there are likely costs impacting supply. Reform is definitely needed, but it involves really tough choices and trade-offs. And that reference rent idea, while maybe theoretically interesting, looks very difficult to actually implement here.
That sums up their analysis on rent controls pretty well, yeah. Calibration and those trade-offs are key.
Okay, let's look at the other big constraint they dive into. The funding gap for housing, which is covered in Box B. What exactly do they mean by this funding gap?
They define it pretty clearly. It's the difference between the sheer amount of money, the credit needed to finance building homes at the scale we actually require, hitting those 50,000 plus units a year targets.
Right.
And the amount of credit that's actually available from the traditional sources, mainly the banks.
And this problem has roots partly in what happened after the financial crash.
Yes, that's a key part of the story. After the global financial crisis, you had much tighter regulations imposed on banks, both from Europe and here in Ireland.
Basel rules and things.
Exactly. Banks had to hold more capital. They faced higher funding costs themselves, partly because of the legacy of bad loans, non-performing loans, or NPLs. The upshot is Irish banks became much more cautious, and the amount they lend for property development just shrank dramatically compared to the Celtic Tiger era.
Figure 13 in the report shows that household deposits in banks have massively exceeded the amount banks are lending out since 2016. So the money is sort of there in the system, isn't it? Why isn't it being lent for housing?
Well, the report makes that point. Yes, the deposit base is huge. But just because the money's sitting in accounts doesn't mean the banks are automatically willing or, under current rules and risk appetites, able to lend it out for what they see as relatively risky long-term development projects on the massive scale needed.
And Figure 14 shows that starkly for residential development.
It really does. Credit specifically for building or investing in residential property has basically flatlined. It's stuck at around $2 billion per year since 2017.
$2 billion. And what was it back at the peak?
At the peak in 2010, it was around $18 billion.
Wow. That is an incredible collapse in traditional bank funding for home building.
It's a massive structural shift.
So how much more funding does the report estimate we actually need each year to bridge that gap and build enough homes?
Okay, so to fund just an extra 20,000 homes a year on top of what's currently being built, if that had to come solely from traditional domestic finance, like the banks, well, you'd essentially need to double the current level of lending for residential development.
Double it.
Yeah. They estimate the need is somewhere around $5 billion extra per year, and that's assuming the state is also funding some direct build itself. If the private sector had to fund it all, the gap would be even bigger.
Are other sources of funding stepping up to try and fill this huge hole left by the banks?
Yes. Thankfully, the report highlights that other players are involved. A big part of why supply has increased at all in recent years, despite bank lending staying flat, is increased state spending. Through approved housing bodies, the nonprofits, local authorities building council housing, and the Land Development Agency using state land, that direct state action is crucial.
Okay.
And then you have the non-bank lenders, sometimes called alternative lenders, credit funds, that sort of thing. They're playing an increasing role too, particularly in commercial real estate, but also moving into residential. The report notes they account for about 35% of loan balances for some sampled property firms.
So the conclusion from Box B is that traditional bank lending is way, way lower than what's needed. How does the report suggest we actually bridge this major funding gap? What's the solution?
The report concludes it has to be a mix. There's no single magic bullet. It requires continued, likely increased state funding for direct provision.
Right.
And importantly, they stress the state's role in also crowding in private investment, using state funds or guarantees to make projects less risky for private builders and funders. They mention Project Tose as an example of that.
Okay, so the state helps de-risk things. What else?
It also needs some increase in lending from the traditional banks, if possible. Continued growth from those non-bank lenders is important. And we also need to attract funding from international capital markets. It has to be a multi-pronged approach.
Okay. Beyond the big issues of funding and rent controls, does the report mention other things holding back housing supply?
Yeah, briefly it touches on other well-known challenges. Construction costs remain high, both materials and labor, even though general inflation has eased.
Still expensive to build.
Definitely. Persistent problems with planning delays and regulatory bottlenecks are mentioned. And just the difficulty in getting essential infrastructure, water, roads, power in place quickly enough to support new developments, all these play a part.
The report also looks at leading indicators, like planning permissions and commencement notices when building actually starts. But it says the link between those and actual finished homes isn't as clear as it used to be.
Yeah, that relationship seems to have weakened a bit since COVID, maybe due to supply chain issues or other delays lengthening build times.
I saw the commencement figure for 2024 looked enormous, like nearly 70,000 starts. Does the report think that means we're going to see a massive flood of completions in 2025?
Not necessarily, no. The report is quite cautious there. It suggests that huge jump in commencements towards the end of 2024 might be a bit artificial,
How so?
possibly influenced by developers rushing to start projects before things like the development levy waiver expired, so getting foundations in the ground, basically.
Ah, okay.
They don't think that 70,000 number signals a similar massive surge in finished homes in 2025, not like that number might have implied in the past. Figure 11 actually shows their model, based on typical build times, predicted far fewer commencements in 2024 than actually happened.
Right. So based on all these complex factors, what are the ESRI's actual forecasts for housing completions over the next couple of years?
The forecast is for a modest rebound, but nothing spectacular. They predict 34,295 units finished in 2025.
Okay, up a bit from 2024.
Yeah, and then 37,413 units in 2026. So moving in the right direction, but still well below those estimates of underlying demand. The gap remains very large.
Okay. Let's move on then to prices. What's happening in our pockets? The inflation picture. How did things look at the start of 2025, according to the report?
Well, the good news was inflation had cooled down a lot. The main consumer price index, CPI, was running at 1.8%. And HICP, that's the harmonized EU measure, was even lower at 1.4% in February 2025.
So pretty close to the ECB's 2% target.
Very close. And interestingly, Ireland's HICP inflation was actually lower than the euro area average at that point, though the report does caution that could reverse if our domestic economy keeps growing faster than the eurozone average.
What's actually driving inflation now? It feels different from a year or two ago when energy prices were soaring.
It's shifted dramatically. Yeah, figures 24 and 25 in the report show this really clearly. Housing and energy costs, which were the absolute main drivers of the spike before, their contribution now is basically zero or even slightly negative.
Because energy prices fell back.
Exactly. Largely because energy prices came down from those peaks. Rents were still adding to inflation, but the imputed rent for homeowners component slowed right down.
So if it's not energy anymore, what is pushing prices up?
It's services. Figure 26 shows services inflation has been running considerably higher than goods inflation since way back in 2023.
Okay. Any particular services?
Yeah, figure 28 really pinpoints it. The biggest current driver is domestic, non-traded services, and specifically the restaurants and hotels sector stands out. Prices in restaurants and cafes, for example, were up a hefty 6% over the last 2 quarters covered.
6%, that's quite high. And the report links that pressure in domestic services directly back to the tight labor market.
Yes, that's the explicit connection they make. With unemployment staying so low, around 4 or 5% for well over 2.5 years now, businesses, especially in labor-intensive service sectors, face pressure to increase wages to attract and retain staff.
And they pass those costs on.
Right. And historically in Ireland, as figure 27 shows, there's a pretty strong correlation between periods of very low unemployment and higher inflation in services. It's a classic sign of domestic demand pressure.
Now, what's really fascinating, I think, is the report's analysis of how inflation hits different people unevenly. It's not the same experience for everyone.
This is a really important point they make. Using CSO data shown in figure 29, they estimate that during that really high inflation period, 2022-23, people on lower incomes actually faced significantly higher inflation rates than the average.
It's how much higher?
On average, their personal inflation rate was about 1 percentage point higher than the headline rate.
And why is that? What makes lower-income households more vulnerable?
It comes down to their spending patterns. Lower-income households inevitably spend a much larger proportion of their total budget on absolute necessities, things like housing costs, rent, or mortgages and energy bills.
Yeah.
And those were precisely the categories where prices rose fastest and most dramatically during that period. The report specifically points out the difference, too, between lower-income renters, who faced big rent hikes, and homeowners whose imputed housing costs didn't rise nearly as much.
So the implication for policy, then, is that if we see another spike in inflation, especially in essentials, support measures really need to be targeted.
That's exactly the conclusion the report draws. Any future cost of living supports, particularly if inflation is driven by housing and energy again, should ideally be focused specifically on lower income groups to be most effective and fair. Flat rate payments maybe aren't the best approach.
Makes sense. What about future risks to inflation? Where could prices go from here?
The ESRI mainly sees upside risks coming from those domestic pressures we just talked about, the tight labor market potentially keeping services inflation stubbornly high.
Of course.
There's also the external risk we discussed earlier. Potential U.S. tariffs could push up the prices of imported goods.
Right. But there's also that really interesting little nugget in the report about trade barriers within the EU itself.
Yeah, this was quite striking. They point out that while the U.S. accounts for about 16% of our goods imports, the EU accounts for 35%. And they reference an IMF estimate suggesting that existing non-tariff barriers within the EU single market red tape, differing standards, etc., could be equivalent to something like a 45% tariff on manufacturing goods.
45%. Wow.
So the implication is reducing those existing barriers within Europe could potentially have a bigger positive impact on lowering import prices for Ireland than even avoiding future U.S. tariffs.
That's a really thought-provoking point. We should definitely come back to that.
Yeah.
But first, let's cover the labor market, the people at work section. And we started off saying the news was good here, low unemployment.
Right, just to reiterate that. Unemployment very low at 3.9%, employment at record levels around 2.8 million people. They do note a couple of small trends. Youth unemployment ticked up slightly recently, widening the gap compared to older workers, and there was a slight shift from part-time to full-time work towards the end of 2024.
And overall labor force participation, the share of people working or looking for work, that stayed high too.
Yeah, it seems to have stabilized around 65%, which, as Figure 33 shows, is very close to the record high level for Ireland.
Now, the report has a special focus, Boxius, on older workers, specifically the 45 to 64 age group. Why is this group so important for the Irish labor market right now?
It's really down to demographics. Ireland's baby boom happened later than in many other European countries.
Yeah.
So we now have a growing proportion of our population hitting that middle to older working age bracket, 45 to 64.
Okay.
That group grew from about 20% of the population in the late 90s to 25% now, and it's projected to keep rising, even exceeding the EU average share soon.
And they're contributing to labor supply growth, not just because there are more of them, but because more of them are actually working.
Exactly. Figure 35 breaks it down. It's both factors, more people in that age group and higher participation rates within that group.
And is it particularly women in that age group whose participation has increased?
That's a key part of the story, yes. The report highlights a really significant increase in female participation rates in those older working age groups. They're now catching up fast with male rates, especially in the 45 to 54 cohort.
Why is it happening?
They suggest it's partly a cohort effect. Basically, women entering this age group now have different life experiences, higher education levels, benefited from childcare supports, and face different social norms compared to previous generations, leading to higher attachment to the workforce throughout their lives.
And the report even compares Ireland to Switzerland, a country known for high participation, to suggest there's still room for our rates to grow.
Yeah, they use Switzerland as a kind of benchmark. Figure 37 shows what they call clear evidence of convergence between Irish participation rates and Swiss rates for these age groups. The gap has closed significantly, suggesting that, yes, there might still be potential for participation rates among older workers here to continue rising towards those high Swiss levels.
So putting it all together, what's the ESRI's overall forecast for the labor market? Still looking strong.
Yeah, pretty strong. They expect unemployment to remain very low, forecasting 4.2% in 2025 and ticking up only slightly to 4.4% in 2026. And employment is expected to keep going too, reaching nearly 2.82 million this year and maybe 2.875 million next year.
Okay, so wrapping things up then, the ESRI report basically shows the Irish economy came into 2025 from a position of, well, pretty clear strength.
That's right. You've got that really robust labor market. You've got decent domestic demand growth forecast. The foundations look solid.
But the outlook is definitely complex. It's a real balancing act between those ongoing strengths and some pretty significant risks, both looming internationally and right here at home.
Absolutely. Globally, that potential for U.S. trade policy changes is the big known unknown, isn't it? With very specific potential impacts for key Irish export sectors.
Yeah.
And then domestically, those persistent challenges, the huge structural gap in housing supply, which is tangled up with funding issues, construction costs, and questions about policy effectiveness like rent controls, Those remain absolutely critical.
And managing those domestic inflation pressures, too, especially in services driven by that tight labor market,
Yeah.
that's still a key challenge.
Definitely. Keeping that contained without stalling growth is the tricky part.
And the report really seems to underline that policy choices, government decisions, are going to be really important in navigating all this.
Yeah, it comes through strongly. Things like exactly how housing policies, including any reforms to rent controls, are designed and calibrated, ensuring any future cost of living support is targeted properly. And the whole question of the state's role in unlocking and crowding in that desperately needed private finance for housing, these policy decisions will really shape the path ahead.
So what does all this mean for you listening? Well, this deep dive into the ESRI's latest commentary really paints a picture of an economy that's shown impressive resilience, but it's clearly grappling with some powerful forces, both global headwinds and tricky domestic knots to untangle.
Yeah, we've seen how trade tensions, potentially kicking off thousands of miles away, could directly hit major Irish industries and maybe even the price you pay for some goods here.
And right here at home, that critical, often frustrating challenge of housing supply. It's not just about bricks and mortar. It's deeply tied into these complex webs of investment finance, high construction costs, and how well policies like rent controls are actually working or not working in practice.
Understanding those connections, how the global feeds into the local, how domestic problems have multiple interacting causes, it helps us get beyond the simple headlines, doesn't it? See the bigger, more nuanced picture.
It really does. And maybe here's a final thought to leave you with, something to mull over. Given the report's really quite striking point about existing trade barriers within the EU single market,
Yeah.
the idea that reducing those barriers could potentially give us a bigger boost or help lower prices more than even avoiding potential U.S. tariffs. What does that suggest about the perhaps overlooked opportunities, the efficiencies we could gain just by focusing more on streamlining things right here on our own European doorstep?
That's a really interesting angle, isn't it? Definitely something worth thinking more about.